Hello friends, last week in my video, I suggested that the data did not really indicate that the bulls were under any sort of threat and the markets did not fall as much as people really feared. Now, in the coming week, what really has changed from the prior week? What are the bulls going to watch? What you need to be monitoring is something that I will cover in this video. Let's dive right in and look at the market roundup window on your screen, which indicates that it was the broader based Nifty that lost less ground, and the bank specific bank Nifty lost major percentages because of pressure points that we'll discuss in the coming few minutes. The US dollar index continued to rally and it gained 62 basis points, and that had a downward pressure on silver and natural gas. Crude oil went up due to reasons that I discussed in the last week: hurricane season, supply side constraints by output cuts, and we saw the USD INR, which is the US dollar versus the Indian rupee, also rise sharply by 27 basis points. The Indian 10-year benchmark bond yield jumped. Now that is a quantum jump and we'll cover that in the bond segment. The NSE gained in market capitalization, which tells you that the broader markets were up. It was the index heavyweights that were under pressure. MWPL, or market-wide position limits, came down due to expiry, which is routine, and the overseas indices went up. The US specific overseas indices went up, providing tailwinds to our domestic markets. Friends, I now come to the in-house indicators, and the first one off the block is market-wide position limits. Now, this is something that indicates how much of positions the traders have utilized as a percentage of the total allowed by Securities and Exchange Board of India. Now, for the fifth consecutive expiry, we have seen the MWPL make a higher bottom after expiry, and that tells you that traders are surrendering fewer positions on expiry and managing to roll over a greater component. That tells you that risk appetite definitely remains fairly high, and should the MWPL continue to rise after expiry, which is the norm, and cross the previous highs, it would tell you that buying conviction or selling conviction on the flip side also remains firm. This will lead to higher volatility because one of the two sides will have to surrender their positions, and whenever they do, these large positions being squared up will result in larger price moves. Now we come to the stock and index futures turnover. These are three concurrent expiries, which is August, September, and October. The turnover spikes up every 4 weeks, which is due to expiry, and expiry results in dual turnover. First, you square up in the July series, and then you initiate the same exposure in the August series, so the exchanges record the turnover twice. So every 4 weeks you'll see a spike, and this is along expected lines. But what we have seen is, even after discounting the expiry aspect, stock futures turnover is at a period high in this 20-week chart. That tells you that one marshmallow traders were participating fairly robustly in the week gone by. Now for the NSE advanced decline ratio, which after the price itself is the best leading indicator of which way the markets are going. The advanced decline ratio has come down marginally to 1.03. Remember, this is the average of the last 5 trading sessions of the week. What we are seeing is the average has slipped for the 4th consecutive week in a row but remained above 1. So at 1.03 for every 100 losing stocks, there were 103 gaining stocks. The Nifty has fallen 0.5% last week, but the advanced decline ratio still remains above 1. That tells you that the broader markets are not as negative as the headline indices. Watch this ratio in real time. I update this chart on a daily basis on our social media accounts. Now for the Nifty and Bank Nifty prompt futures basis. Basis is nothing but the premium or discount prevalent in the futures as compared to spot. And this is a weekly chart, so we are taking basis on a Friday to Friday. Bank Nifty and Nifty basis jumped, with the Bank Nifty almost at a period high in this 20-week period, because the players are getting 4 full weeks to trade in a new derivative series and are therefore willing to pay a higher premium. But part of this is due to short covering, and I feel that such lofty basis is unlikely rather to sustain for too long, and you will see time erosion, just like you have options premium eroding over time due to time decay. This basis will also settle lower in the coming week or two. As long as the basis is positive, which is futures are trading above spot, bulls still have a chance to basically pull markets higher. I now come to our exclusive in-house indicator, the impetus, which you've trusted for 2 years now. And I have been telling you in the last few trading videos that the Nifty impetus, which is at a period high, and such parabolic rally in the impetus was unlikely to sustain. And sure you have it. Like I mentioned in the last two videos, there was likely to be consolidation in the impetus, and you've seen a sharp decline in both the impetus readings of both the indices, because the upward momentum was halted. And just as the Nifty impetus rose far more sharply as compared to Bank Nifty, the correction in the impetus has also been far more sharper. Now, what we do need to see, rather than the impetus, focus on the price. As long as the impetus is falling but the price is not, that would be a kind of somewhat of a quasi-bullish indication. In the near term, I wouldn't be surprised if there is some consolidation occurring, all fair after a good rally that we've seen in the last few weeks, especially since we've been outperforming our global market peers. Friends, I now come to the lift, weight, thrust, drag index, another exclusive in-house indicator that you won't get elsewhere. You've been trusting it for 5 quarters now. Now, the LWTD indicator shows that the Nifty has fallen 0.5% on a week-on-week basis, and the LWTD has also come down by 20 basis points, but it remains above zero, which tells you that although buying support at lower levels, primarily from even short covering, might continue to emerge at declines, it might just be relatively marginally lower than the week gone by. But support is likely to come. The coming few minutes will tell you why I'm saying what I'm saying. Friends, the in-house indicators done, I now come to the bond market, which we have been covering in advance compared to the broader market participants. And I feel that the bond markets are actually the fountainhead of money supply, which fuels the other asset class markets. And what you are seeing on the weekly chart is that the bond yields have jumped sizably, and as a matter of fact are now poised at 15-week highs. That tells you that the RBI Monetary Policy Committee meeting, which is likely to be held between 8th and 10th of August, is something that the bond markets are gearing up for. Remember, the US Federal Reserve has raised rates by a quarter percentage point, that is 25 basis points, and they have not ruled out fresh rate hikes. So cash carry considerations might just force emerging market central bankers to follow suit. This is something that the RBI 10-year benchmark bond yields are seemingly indicating, or rather trying to factor in. Now, since bond yields have risen, bond prices would have fallen. If bond prices have fallen, it is one of the many reasons that the bank Nifty has fallen, because banks are the biggest investors in government bonds, and they have a mark-to-market notional loss on their bond portfolios. Let's monitor the bond yields and keep our ears to the ground in the near future. Friends, the bond market's done. I now come to the Bank Nifty, which took it on the chin. It basically lost more than the Nifty 50 at 1.32%. It fell on 4 out of 5 trading sessions last week. The monthly moving average, the month-long moving average has provided a rough and ready support, as you can see on the daily chart on your screen. And the short-term outlook so far appears to be positive as long as the price is above the moving average. But should the price continue or begin to close below its month-long moving average, you could see short-term bulls coming under pressure. Do remember that recently you've had an expiry of July futures, so bulls would have paid cost of carry to roll over their long positions. And after you've incurred the cost of carry, when you see prices go down, you are suffering a bigger loss, a loss that is bigger than what the chart indicates. So that is one area that you need to watch out for. Coming to the weekly chart, what you are seeing is that a power candle that we saw in the week before last, the bullish power candle, was followed last week by a bearish piercing candle. Now the piercing candle is made when you see the bearish candle with a smaller body pierce the previous week's bullish candle by at least 50% of the body's length. By itself, it is not an outright bearish indicator. What happens in the follow-up coming week is what will determine as to what you should expect in the market. Now, what we are seeing is that on the daily chart, we saw how Thursday was a big declining day with a bearish power candle. So the high of Thursday, something that you need to watch out for as an immediate resistance point. In the week before last, this index was at number 1 on our statistical beta list of most volatile counters that we maintain in-house. It slipped 5 notches to number 6. Part of the reason was because the bullish momentum slipped off and volatility in individual stock futures went up, relatively speaking. So the index appears to have become less volatile. Last week, I advocated a range between 47,200 on the upside and 44,950 on the downside, which held perfectly well. In the coming week, I anticipate an estimated range between 46,400 on the upside and 44,325 on the downside. I would be trading the Bank Nifty rather lightly because volatility is something that I expect to go up in the week ahead. Friends, the Bank Nifty done. I now come to the Nifty 50, which relatively speaking outperformed the Bank Nifty because it fell only 0.5% as compared to the Bank Nifty. It also fell on 3 out of 5 trading sessions as compared to Bank Nifty's 4 out of 5 trading sessions. So to that extent, it was relatively better. Thursday again was a noteworthy negative day, as you can see on the daily chart on your screen, and it is only after the high of Thursday, which happens to be at 19,868 levels in the spot segment, which will be needed to revive sentiments and put some hope in the bull camp. The price remains above its month-long moving average, and that basically tells you that the short-term outlook remains positive for now. Going to the weekly chart, last week, I had mentioned that what you are seeing as an inverted hammer was a Nagareboshi or a shooting star candle. I had also mentioned that by itself, it is not a bearish candle unless and until the low of that candle was not violated on a sustained closing basis. And should the high of that candle be overcome on a sustained closing basis, the bearishness would be negated. But just like the Bank Nifty, you are seeing a bearish piercing candle here. The last bearish candle's body has pierced the previous bullish candle's body by 50% or more. Just like the prior week, you either have the price moving above the last candle's high or trading below the last candle's low. That would determine which way the direction the market would take. Now, in the week before last, this index was at number 5 on our statistical beta list that we maintain in-house. It slipped 3 notches to number 8. Here again, the reason was individual stock volatility went up far faster than the Nifty's volatility. Last week, I advocated estimated ranges between 20,125 on the upside and 19,350 on the downside, which held perfectly well. In the coming week, I estimate a range between 20,000 and 25 on the upside and 19,250 on the downside. Here again, I would suggest you should trade light because the volatility can be fairly high. Now, friends, the crux of this video was what would the bulls be watching out for this week? If you notice something, Friday was a day when two very critical things happened concurrently. Number one, the Indian benchmark bond yields shot up. And they are now at 7.16, 7.17. And secondly, the USD INR also went up sharply. Although we are not at a period high or a new all-time high, but the fact remains that the Indian rupee depreciated against the dollar fairly sharply, and it coincided with the Indian bond yield spiking. Now, these are two aspects that should be on the back of the mind of a savvy trader who would be watching out for triggers from where he would basically draw his next trading strategy. A weak rupee is unlikely to be a very cheerful indicator for an average Joe who's a bullish trader. And bond yields ahead of the RBI Monetary Policy Committee meeting, like I mentioned in the early part of August, is also indicating that bond markets are trying to factor in the probability that the RBI could either give out a hawkish signal or even might, as an off chance, of course, even be forced to raise rates. So these are the two things that a savvy bull would be watching out and maybe slightly, just slightly worried about. To that extent, the market could see some amount of consolidation. But is it the end of the bull market? I would say not yet. Let's not jump the gun. It's not that bad as yet. Friends, I now come to the last bit of statistical analysis wherein I measure the retail risk appetite by the turnover that they initiated in the 4 segments and what it means for the markets. Friends, on the chart on your screen is the turnover aspect, which tells you that index futures turnover shown as a blue line have gone up by 3 basis points. The stock futures turnover has also shot up fairly significantly. Now, is this really indicating risk appetite or is there something more to it? Do remember where I indicated the index and stock futures turnover in the beginning of this video. I told you that this happens every 4 weeks because it coincides with the monthly expiry of the derivative series. So here again, the turnover rising is basically more a function of expiry than an absolute indicator of risk. And where stock options are concerned, they were more or less flat in the turnover contribution, whereas index options turnover fell pretty sharply. That tells you that traders were, relatively speaking, taking a higher risk appetite, not because they were trading higher risk instruments, but because they preferred to trade lower risk instruments a little lesser. So there's a very indirect and oblique way of saying that risk appetite went up. I would say they were guardedly optimistic. Friends, I now come to the segment where I would share my trading blueprint for the week. I would continue to focus on public sector units, like I said last week, and within the PSUs, I would focus on PSBs or public sector banks. Metal and energy stocks are other areas where I would remain watchful for trade in either direction, depending on which way the snapcode window was guiding me. These sectors will remain vibrant and volatile and therefore provide intraday traders a good amount of opportunities. Although I will be cautious and I would trade light because volatility going high means you take a small exposure and you wait for larger price moves. Do remember that the RBI meeting between 8th and 10th of August will weigh on the market sentiments. In the commodity space last week, I told you that if you are an option writer, go easy on theta decay strategy on call options in crude oil because I was expecting the price to go up. That was more than validated by the market because an almost 4.5% increase in crude oil prices on a week-on-week basis. So continue to go easy on theta decay on calls. Use our weekly and daily pivot point updates, which we update only on our free Telegram channel. To make it a point to subscribe to that free channel and make use of the equity and commodity futures pivot points on daily, weekly, and monthly basis that we put there. So theta decay players can continue to do so, but with a good degree of caution. Pressure points, like I mentioned earlier, will emerge from the currency peg and bond yields. So we need to watch out for these two data points very clearly. Friends, I now come to the most popular segment of this video wherein I give you 5 stocks that have gained the most amount of impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks that have lost the most amount of impetus on Friday, where you take big exposure, wait for small price moves. This list is valid only for Monday. Tuesday through Friday, I updated on our free Telegram channel. Do make it a point to subscribe there. So the impetus gainers list is led by Ambuja Cements, followed by ACC, then Torrent Pharma, Cipla, and Marico. Impetus losers list is led by Delta Corp, Aarti Industries, Titan, National Aluminium, and Federal Bank. Friends, before I sign off from this video, a reminder to subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here in the comment segment. Do let me know how my videos are helping you become a better trader, and also help me reach out to fellow like-minded investors and traders like yourselves by sharing our video with your friends and family. Thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. Had a very, very profitable week ahead. Bye-bye.